Hello, this is Eric Parnell, Chief Market Strategist from Great Valley Advisor Group. Here for this latest market insight, joined by Evan Coffey, investment analyst from our team. So what do we have to talk about here today, Evan?
Well, Eric, first and foremost, it's great to be down here in Charleston, South Carolina, at the Emeline Hotel for Great Valley Advisor Group's annual advisor conference. And what perfect timing to have a special edition of Market Insights, as these last few weeks have been a little bit tumultuous within financial markets. We've had quite a bit of news. The latest this morning, breaking news that we're one step closer to coming out of the United States' longest government shutdown, currently at 41 days. But 8 Democrats, cross party lines, voted for a plan that would see the government funded through the end of January. Now, there's still some minor hoops that Congress will have to jump through, some more debate in the Senate, and then obviously the House, which is Republican majority, passing said deal. So, I think when we met last time, the shutdown had just started, and we felt like this was going to be somewhat of an ephemeral situation, something that would be, it could be a factor, but not for financial markets. And here we are 41 days later, and I still don't think it's been a huge factor for financial markets, but it's certainly been a factor for the American citizen. We've seen factors and characteristics like growth in flight delays. Being down here at a conference, we heard about that anecdotally. We've also seen, over 1 million federal employees not be paid during this period. And then emergency contingency plans for low-income households to get the food aid that they need. So the American consumer has been affected by it. I think that the effects in financial markets, beyond the 7 to 14 billion estimated to be permanently lost in economic output, have been relatively unaffected, except for this dark window that we've had in terms of financial data. And that's kind of what I want to unpack with you, is that we got the September CPI report. It came in lower than expected at 3% for both core and headline. A 30 basis point month over month increase. And the markets like this, but we quickly entered a government shutdown and things started to go dark. We didn't get labor data. We're not going to get a CPI report in November that would reflect October CPI. We haven't gotten industrial production reports. We haven't gotten construction reports. So the health of the economy is somewhat ambiguous to us. We don't necessarily know where it's at right now. So my question to you is, knowing that there's light at the end of the tunnel, we expect the government likely to be open by the end of the week. Are there going to be residual effects from this? Is this something that we need to keep in mind, especially with a Fed decision at the end of the year?
Yeah, no, it's a great question. And it's interesting because you have the immediate effects that are likely to be seen on the economy. But in certain respects, it's really potentially bullish for the stock market in the intermediate term. To your point, there's a gap in data. It had a material effect on certain people in the economy. If you take 41 days away from work, it's not like you go back to your job and you don't have a backlog. So there's some catch-up work that's going to need to take place. But what we saw here with the government shutdown, we've seen it before, and we've seen it this time play through. Longest shutdown, the markets looked right through it. As long as the markets are getting their liquidity, they show the propensity to be able to trade at new all-time highs. Did they pull back here more recently over the last week? Yeah, but they did so in a well-behaved technical manner. Stocks pulled back, hit the 50-day moving average, and subsequently bounced once this news came across the wires today. And if we do see any type of material effect on the economic data, once it starts to get reported again by the government, any sort of weakening, I think the market will read it as a positive signal, because for the markets, it will be more justification for the Federal Reserve to provide those additional rate cuts that give that added liquidity that the markets like so well.
So I want to unpack, though, and push back a little bit about this December, FOMC meeting. Final interest rate decision on the year. The Fed is set to meet on December 10th. The last 2 meetings, they've cut by a combined 50 basis points, 25 at each. And I think that coming out of October's meeting, it was, the market felt like it was a sure sign we were going to get 25 more in December. Fed Chair Jay Powell immediately shut that down, said, hey, we need to pump the brakes a little bit. This is not a sure sign that, and a guarantee that we're going to get 25 more basis points off of the federal funds rate. And then you throw in a government shutdown and a black box, of data. Is there a concern that we get to December and that we do get a CPI report, and we do get some of the data, starting back up, that the Fed feels like they need to pump the brakes and they need to just pause because, the CME FedWatch tool currently sitting at 66% that we get a cut, but there's now 33% that we don't. Do you think that this rises? Do you think that there's a reason that the Fed needs to wait?
Oh, yeah. I mean, I got to be honest with you. I think the Federal Reserve, I'm not sure that they needed to be cutting interest rates to begin with. I mean, you look at the economy, GDP growth continues to be in the 3 to 4% range. We have economic output that continues to exceed expectations. I mean, where is this recession that we've been waiting for the last 3 years? It never materializes because the economy continues to remain resilient. Corporate earnings are growing at a double-digit rate. You have risk asset markets that are trading at all-time highs. There's really not an urgency in order to be cutting interest rates. Are we seeing some weakness in the job market? Absolutely. But are we seeing it to the magnitude where we need to be entering into successive rate cuts? I'm not so sure. And what particularly concerns me is that, yes, the most recent inflation data for the month of September that was released, although the headline numbers and the core numbers look solid, kind of giving the numbers that the market wanted. When you get underneath the surface of that data, there is material signs of rising inflation that are building underneath the surface. And one of the keys to watch here as we get more inflation data, as things get back online, is goods inflation. That's what drove the spike in inflation in 2022. And it is steadily rising right now. And if you look at month over month inflation data, if you look at median CPI data, it's getting hotter. And if that continues to get hot in the months ahead, the Fed may rue their decision to have been cutting interest rates as much as they have so far.
Yeah. Yeah, I think that it's something that, as an asset management team, we're going to need to monitor heavily going into the end of the year, but also in 2026, because, I think that in years past, we've started the year and we've gotten predictions for, 5 cuts, 10 cuts, and it never pans out how it's predicted. So definitely something that we're going to be mindful of. The final thing that I want to unpack is something that you briefly mentioned in your first point. And that's that there was a little bit of steam that came out of the AI trade last week. Now, we've seen a relative pop, filming this today on Monday, after the news of steps towards ending the government shutdown in all major indices. But last week, we saw a major sell-off in some of the biggest tech names. NVIDIA, Meta, Palantir, Oracle, they fell by approximately $800 billion last week. That's substantial. It's not something to just, drive right by and not worry about. So, it was the worst week for the NASDAQ since the Liberation Day sell-offs. But yet these companies, to your point, their earnings are solid. They're making money hand over fist. Yes, they're spending money hand over fist, and they're doing so in a way that some investors might not like. With Meta, they just issued that latest debt product to fund some of this capex. But I guess my question to you is are we okay? Was that something that we need to dive further under the surface? Since October 11th, Bitcoin is down over 17%. Once again, it's popped today, which has been helpful for it. But that's a liquidity gauge for the market. And so, we've talked a lot about on Market Insights, the concentration and this AI trade, and everything's been up and to the right, and then air comes out of it, and then we get right back to it the following week. So I know that that's not really a clear-cut question for you, but I just kind of want to hear your thoughts about, where we are going into the end of the year. Do we get a Santa Claus trade? We had a relatively good September and October, which historically aren't great months. And then what do these companies need to do going into 2026 for this to be sustainable?
Yeah, I mean, it shows the fragility that is starting to form under the market right now. I mean, the music is continuing to play on the AI trade, which is lifting the broader market. We've seen the S&P 500 hit new all-time highs, and did they pull back? It's amazing that you can have a double-digit pullback on some of these AI names, and you're doing nothing more than regressing to the mean in a longer-term uptrend. And these stocks continue to be well-behaved, even though they drop by double digits. They hit support, they bounce. The music is continuing to play. And it shouldn't be surprising if we continue to see those stocks perform through the end of the year and into January of 2026. Because if you're an institutional money manager and you decided to step to the sidelines in the spring of 2025 because you were worried about the impact of tariffs or an economic slowdown, you're trailing the broader market right now. And is the middle of November the time that you want to decide to be brave and step aside if the market continues to move to 7,000 or 7,200 on the S&P? So we shouldn't be surprised to see further upside in the near term. But the challenge that we're going to be increasingly confronted with as we get into 2026 is these AI stocks are very expensive, and they are also interconnected. So and when I say interconnected, basically meaning that their businesses and their growth are all dependent upon each other. So if you have any break in the link of the chain that connects all these companies together, yes, they're making a lot of money, but if it gets to the point where they're making a little bit less money, or if their gross margins start to compress a little bit, we've seen it in the past. That's all we really need to see. And particularly if there's anything that's going to start to draw liquidity away from the market, those are the types of things that could really, send these stocks down by double digits, and then they go down by more double digits. The last point that you raised, which was a good one, was following the price of Bitcoin. It is your quintessential speculator's instrument, and it is a show of liquidity in the marketplace. And ever since this growth wave started nearly a decade ago, Bitcoin has done a very good job of being a leading indicator for the NASDAQ 100, where so many of these AI tech stocks reside. We have seen weakness in the price of Bitcoin here recently, just like we saw weakness in the price of Bitcoin at the end of 2017 before we had some weakness in the markets in 2018. So it's going to be interesting to see how that plays out. But you want to watch the price of Bitcoin to get a sense of where these AI stocks might go as we go into 2026.
Well, I think that that's a good piece of advice. And as I always say, though, if the music's playing, people are going to dance. So with that being said, Eric, this was a great conversation. I think that we're hopeful that, by the end of the week, we have a deal on the U.S. government reopening, and we'll be mindful of markets and the Fed decision in December. So thank you, Eric.
No, thank you, Evan. It's always great to be with you. And thanks for joining us for this latest market insight in Charleston, South Carolina. We look forward to seeing you again soon.